Good morning and welcome to NYSE Live. I'm Caroline Woods. Stocks are pointing to a lower open this morning as investors digest fresh economic data that points to a much hotter than expected inflation picture. Earlier today, the Bureau of Labor Statistics released the January Producer Price Index, giving investors the latest glimpse into the state of inflation at the producer or wholesale level. We'll dive into those numbers in just a moment, but before we do, here's what else is on tap this hour. Chief executives from a pair of NYSE-listed companies, Grindr and Zeta Global, will join me this hour to discuss their latest earnings. We'll also talk about what role AI is playing in their businesses. Meanwhile, Archaea Media Group, in collaboration with the NYSE, published the second edition of its Space and Defense Market Update, providing an overview of the key trends shaping the sector. You don't want to miss that. And at 9:30 a.m. Eastern, leaders from the 13th Annual IPO Summit will ring the opening bell ahead of today's event here at the Stock Exchange. I'll head down to the trading floor and speak with New York Giants quarterback Jameis Winston, who will be speaking during the summit. I'll ask him about the message he's looking to deliver to attendees from the field to the boardroom. About 30 minutes ago, the Bureau of Labor Statistics released the Producer Price Index for January, giving investors a fresh look at wholesale inflation. Here's what we learned. On a headline basis, prices increased by 2.9% year over year and by 0.5% month over month. Both of those numbers are noticeably above economists' estimates. Meanwhile, core PPI, which excludes the volatile food and energy sector, that came in hotter than expected as well. Core PPI rose by 3.6% year over year and by 0.8% month over month. Estimates were calling for 3% year over year and then 0.3% month over month. Joining me now to break down these numbers, Lauren Seidel Baker. She's an economist at ITR Economics. Lauren, thanks so much for being here this morning.
Thanks. Great to be here.
So I want to get your reaction to this PPI report. I should note PPI is usually not that market moving, especially compared to CPI, but definitely moving the market as it looks this morning. We still have about a half hour to go before the opening bell. What stands out to you aside from the fact that inflation at the producer level is running hot?
Well, it is running hot, and we've known that for some time. The PPI actually reached a low quite a while ago. We have seen rising inflation in these producer price indices, and the CPI, that's where we've seen a little bit more, again, ups, downs, kind of bumps along the bottom, but still very persistent inflation. Now, PPI does tend to lead ahead of CPI. So all of these wage pressures, these energy costs, rising commodity pressures, all of these things that producers are feeling, those eventually do get translated down the chain to the consumer. So overall inflation, this is not a finished story. This is something that we need to be aware of going forward. And I do see rising inflation as being the most likely outcome, whether we're talking PPI, CPI, PCE, any of these indicators.
Okay, if rising inflation is the outcome, obviously we're seeing it with this data this morning. How high can we expect it to get? And what's keeping it not just sticky, but reaccelerating?
So I want to say what's not keeping it accelerating first. This is not just a tariff story. There are other pressures, much more pervasive. We could look at the more technical drivers. We think of like the velocity of money. Treasury issuance is one that I'm tracking, money supply overall. But from a more understandable level, as I mentioned, the labor market's still relatively tight. So all of these wage pressures, they're not building as much as they had been a couple years back, but there's still really a pressure that a lot of firms are dealing with. The energy side of things, that's where we really see an increased driver. Not so much on the gasoline side of things. Oil prices are relatively well contained, but electricity costs with data centers going in more and more places, that's really putting upside pressure on the grid that we just don't have the supply really to meet. So I see these pressures as not going away anytime soon, despite what's happening with, say, a court case leading to tariff relief potentially. These are much, much more pervasive. I don't think, however, that we're getting back to those highs that we saw this most recent kind of 2021-23 cycle. We're looking at the consumer price index probably topping 3% this year, but not reaching the near double-digit rates that we saw a few years back.
But 3% is still far from the Fed's 2% target. So how difficult of a position does this put the Fed in? I was taking a look at the CME FedWatch tool. Seems like the expectation is still for a rate cut in June, but it's almost 50-50 at this point.
Yeah, those market expectations are really losing steam for a June cut. I think we are absolutely on hold for at least a few more months of data. Really, the two forces being opposed here, the two sides of their dual mandate. On the labor market side of things, due to immigration trends, immigration policy coming from this administration, we might not need such a break-even level of job creation. So that unemployment rate, it's still relatively low. As I said before, the labor market, especially in key skilled areas, is very, very tight for a lot of companies. So I know it feels like a tale of two cities. If you're a job seeker out there, you might not feel this trend as much, but some of the dislocations, they're not representing a severely loosening or a significantly loosening labor market. So with the labor side relatively well in hand, if inflation does start to rear its ugly head again, I think that keeps the Fed on hold for a while. And if inflation does in fact rise, again, we at ITR Economics are expecting the next few years to be kind of between that 2 to 4% range on a CPI basis. That could keep the Fed on hold for much longer. It could even make future rate moves go to the upside rather than to the downside with rate cuts.
What is your expectation right now? Are you expecting rate cuts this year, and how many, if so?
We might get another one or two. That's really not going to move the needle on a lot of things from a kind of producer side of the equation. But I really see by year end, I think we will in fact be talking about rate hikes, not further rate cuts. Whether we get those last couple of cuts, the bond market is not pushing through the full amount of Fed rate cuts onto actual borrowing costs. So for businesses, I think it's something of an academic exercise to say, will we get another 25 basis points, even 50 basis points? If that isn't moving the needle on their borrowing costs, certainly on government bonds, on say mortgage costs for consumers, it isn't really going to do too much work for the economy overall.
So sticking with inflation, and then I do want to go back to the job market. You talk about the producer price index being sort of a forward-looking indicator. This is inflation really at the seller level versus the buyer level. If that does pass through, what does that mean for prices for everyday Americans as we think so much about affordability and, having to be pretty choiceful with our spending?
I think this is an ongoing challenge. A lot of our consumers are starting to feel squeezed. So what we really see if we break this down by demographic is that the middle to upper income earners, they're still holding in there relatively well. They're relatively comfortable, but it's that lower income segment. They're very much feeling the strain right now. By one measure that we estimate, about 2/3 of their spending goes to just necessities, things like food, housing, healthcare. And that number is actually worsening, whereas the upper, say, 10% of income earners, it's lower than half of their spending goes to those necessities, and that number is actually decreasing. So we're seeing something of a divergence. I've heard it called the K-shaped economy. That is very much true. If you are on that lower side of things, you do naturally get squeezed a bit more by inflation. So it's very much, I think, easy to pick a certain narrative right now. If we just look at the numbers overall, that's where, again, we see persistent pricing pressures, not as bad as they had been, but it's taking something of an adjustment for a consumer who goes into a grocery store or any other retail establishment and see those prices on store shelves moving much more quickly than they had been. This is changing the consumer mindset, and companies are going to have to be very aware of that.
Yeah, well, I guess a good thing that the labor market is holding in there, because that would only really kill sentiment that much more. We have to leave it there. Lauren Seidel-Baker, economist at ITR Economics, thank you so much for breaking those numbers down for us.
Thank you.
Coming up, NYSE-listed Grindr CEO George Arison will join me in studio to explain why 2025 was exceptional. That's a direct quote for the company. Stay with us.
As we stand on the cusp of America's 250th anniversary, we're reminded of the principles that have powered the world's greatest economy.
The New York Stock Exchange is a cathedral of the capital markets, replete with rhythms and rituals that allocate resources towards socially valued uses. That story will reach a rare milestone when our republic marks its 250th year. Anniversaries of this magnitude demand more than just ceremony. They ask something of us. They invite us to reflect, to ensure that the future that we shape will prove to be worthy of the legacy that we've inherited.
Welcome back to NYSE Live. NYSE listed Grindr reported its Q4 and full year earnings after Thursday's close, which revealed the company's top line grew by 28% last year. Joining me now is Grindr CEO George Arison. He's here in studio. George, great to have you.
Thanks for having me.
All right, so congratulations on a good quarter. I mentioned the 28% revenue growth, 29% year-over-year growth for the quarter. You called it an exceptional year. Tell us what's driving the outperformance.
Yeah, we had a really awesome year. We're really happy with the results, and it's hard to not be happy. Our EBITDA was also the highest I think we've had since we've been public at 44%. And we did more EBITDA in total at $196 million than we did revenue in 2022, the year we went public. So that's more EBITDA than revenue in over 3 years. I think that's my favorite headline from the year. We definitely accelerated growth as the year progressed, partly going into this year. Over the last 3 years, Grindr has built a ton of stuff for our premium subscribers. Mm-hmm. We have 2 subscription models. One is extra, one's called unlimited. One's $23, the other one's $45. And we had added so much value to those tiers that people were getting a lot of stuff that they were not paying for, basically. And so in August, we started to charge people for all that extra value that we had previously created by pushing prices up a little bit. And so way better results on that than we had expected. We thought there'd be some churn when you raise prices. That's inevitable, but the churn was much lower than we thought it would be. And so the results were much better than we had anticipated. But that's very positive because that means people are valuing what they're getting and are willing to pay for it and kind of realize that some increase in price made sense.
Yeah, I think that is an interesting really part to point out because you now have 15 million monthly active users paying up 17% year over year. So at a time when consumers are pulling back on so much, they're continuing to pay for Grindr. Why?
Well, in November, we released some demographic data of Grindr users by age. And what you saw is that 46% of US users, half of the worldwide users, are actually under the age of 30. Mm-hmm. So 18 to 29 is kind of by far our biggest demo. And our payer penetration among those actually is lower. Our payer penetration among users who are older, 30 plus, and especially 35 plus, is much, much higher because we shared the demographics on payer penetration. And that happens because we have a very robust free product. So you can use Grindr really well if you don't pay, and it works very well for you. Mm-hmm. But as you age, you end up appreciating some of the value-added service that we offer in the paid tiers, and you start paying. That's a very different demographic split on payers than most other dating products, where, for example, men are more likely to pay and women don't have to pay because of the way the products are built. And so we end up, I think, doing very well in that dynamic, and a lot of what we're doing long-term is focusing on value-added services at the kind of older generations that want to pay for those while maintaining the free product to be super robust and actually making it even more robust than it is now, because we do want that product to be so awesome for people to come back into the product all the time. And Grindr is very much like a utility. I mean, people spend over an hour a day in the app. They send 50 messages a day. in the product.
That's like social media level stickiness,
yes,
really.
It's WhatsApp. We send more messages per user per day than WhatsApp does. And so in that sense, people use it in a lot of different ways, not just for dating. And that's the reason why they're willing to pay for it, because it's a very critical part of their lives. I mean, you cannot replicate that kind of community anywhere else.
And speaking of demographics, I saw 80% of your users are actually outside the U.S.?
So close to that, not quite 80, but
okay.
Yeah,
so where are you seeing the most growth right now?
So Grindr is a very international company. We're in 190 countries and territories. There's just a few select number of countries we don't operate in, like Iran and Cuba and North Korea, primarily because of U.S. government sanctions. And frankly, even in Iran, we've had requests to come into the country many times by local activists, because for a lot of countries like that, where it's still illegal to be gay, Grindr is usually the only way to connect to other gay people. And that's important, obviously, in places like that. So we are pretty much everywhere, and we have a primary position in almost every country in the world, save a couple of places. But we generate revenue in about 20 countries around the world. Obviously, the United States being primary, and then the countries you logically assume where you can drive revenue.
All right, we only have about 30 seconds left, so give us the quick take on what's next. What can we expect from Grindr?
So this year is all about premiumization. We're using AI to premiumize the product and create new types of experiences that previously were not possible before Gen AI. And we're doing that both in the product, but also in how we work. A lot of it is going to be on, today, about 70% of the code that we generate is written by AI, but that's obviously the start, not the end of where we want to be. And so AIfying the company or terraforming us to be an AI native company is very much a big internal focus, because the leverage you'll be getting on that over the long term is so huge.
Okay, so using AI to find your match, not actually dating AI, which I've also been seeing. Different story there. George Arison, Grindr CEO, thank you so much for joining me here in studio and shedding some light on your company. All right, coming up, shares of NYSE-listed Zeta Global have climbed by more than 10% this week. Its CEO will tell us why next.
The New York Stock Exchange is a cathedral of the capital markets. So there are a few places more fitting to consider the future of the American financial system than this one.
At the NYSE, we applaud SEC Chairman Atkins and the entire Trump administration for working to reduce the burdens on existing public companies and soon-to-be public companies.
I believe that we will ensure that the American story, which began in many ways just steps outside, is preserved not by memory or speeches alone, but by the courage of those who are determined to chart its next chapter.
When we talk about the titans of industry and we talk about the titans of finance, there's a reason that we're all coming together still after all these years to the corner of Wall and Broad Street.
We are ringing the opening bell this morning to celebrate the launch of 6 new ETFs by direction.
We look forward to many more. I mean, today's 6, we're going to do hundreds more.
The New York Stock Exchange, the home of ETFs.
Welcome back to NYSE Live. Earlier this week, NYSE-listed Zeta Global reported its latest earnings, highlighting the firm's 18th consecutive beat and raise quarter. Shares of Zeta are up more than 10% so far this week. Joining me now is David Steinberg, Zeta Global's co-founder, chairman, and CEO. David, thanks so much for joining the show.
Oh, thanks for having me, Caroline. I always love being on.
Well, I'm glad to have you. And first things first, in case Zeta is unfamiliar to some of our viewers, you've called it the largest big data company that nobody's ever heard of. So give us a breakdown of how you're actually helping brands find customers here.
So we use one of the world's largest data clouds. We have 552 million people who are opted into our data cloud that we have trillions of data points on to train our proprietary artificial intelligence models to help very large enterprise meaningfully lower their cost and create much higher return on investment for customer acquisition, retention, and monetization.
Okay, so 18 straight beat and raise quarters. At this point, that's not luck. So what allows you to really deliver that level of consistency?
First of all, I'm super proud of the team. We were joking the other day. We just realized that this is our 18th year and our 18th consecutive quarter. So it was exciting. What I would tell you is that we solve our clients' biggest problems. For every dollar a marketer spends on our software, we return them $6 to $7 in revenue. That's a 600 to 700% return. And when you do that, your clients are going to continue to spend more. Last year, I think one of the things that people were very excited about is we had a net retention rate of 120% as a company. And when you do that, it's sort of easier to understand your numbers and have a lot of visibility and to hit that 18 of 18.
There's a lot of talk about this SaaS apocalypse right now, the idea that AI is going to kill software as we know it. Why is AI an accelerant for you versus a threat?
Well, first of all, I've seen a lot of silly narratives over the years on Wall Street. This might be the silliest. I equate it to when the internet came along and everybody said software was going away. When cloud computing came along, everybody said it was going away. And in all cases, these technologies were plugged into software platforms like Zeta, which we're doing now. We've already announced a major partnership with OpenAI that I think people are really discounting. But we're also using Anthropic today. We're also using Gemini today. We're also using Microsoft Copilot today. And you could go through the whole different scheme. We started programming at Zeta in AI in 2017. In fact, Caroline, the day we went public, we put the big flag on the outside of the New York Stock Exchange. Ours said data plus AI equals intent. And everybody was asking me, who's Al? And why is he in charge of your data policy, right? That's how long ago that we started doing this. But this narrative is just not right. Now, what I think will happen is we will integrate large language models as we've done with Athena, which is our conversational super agent, which we think is really the next generation product that will allow our clients from a voice perspective to control our platform and be navigated through it. We'll adopt all of these platforms. We'll pay them. They'll take a percentage of what we make in the form of payment, but they're going to make our businesses so much more efficient that it'll more than offset the cost of using those platforms. So one of the things I also talk about is, years ago we had hosting centers. Now we use cloud computing. AWS is one of our biggest partners. We work across all of them, quite frankly. But AWS is one of our larger expenses. But at the same time, we've added 500 basis points to operating margin over the last 3 years. And we've grown the business substantially faster than our AWS expenses has grown. So I think you're going to see a very similar thing with the large language models. Now, listen, if you're running a company that is purely workflow management based, you might have some challenges, adopting, and you're going to need a new strategy. But for Zeta, we're creating intelligence. And that intelligence results in a 600 to 700% return on investment for our clients. Our clients look at us as a revenue center, not a cost center, which is an important place to sit with a client in today's environment.
Okay, we only have about 30 seconds left, but what makes 2026 a beat and raise year as well? What needs to happen here? Other than maybe lifting your expectations a bit.
I was going to say, right? You're already hitting me on this. What I would say is our goal as a public company is to beat and raise for as many quarters as we can. Our goal is to be sitting here with you next year and talking about our 22nd consecutive beat and raise quarter. I mean, we raised guidance. We're already guiding to a 35% revenue growth this year, a 40% EBITDA growth, and a 40% free cash flow growth. We had our first net income positive quarter in Q4, and we're guiding to being net income positive for this calendar year. You know, we're going to have to keep solving our customers' biggest problems, but when you have a net retention rate as high as we have it, it's easier to forecast and it's easier to meaningfully grow your company.
Okay, well, I hope I'm here next year and that AI hasn't taken my job by then. David Steinberg, Zeta Global's co-founder, chairman, and CEO, thank you so much.
Thank you for having me, and I'm highly confident you'll be here in a year.
All right, you heard it here first. In other news, the space industry has been a hot topic on Wall Street as well as here at the New York Stock Exchange. Just last month, York Space Systems celebrated its IPO by ringing the opening bell. Let's take a look back at that moment.
From the beginning, our role at York is to deliver the most critical systems our country needs for the American people. That clarity of purpose is what brought us to this moment, and it's what will carry us forward as a public company.
It's frozen, 2.8 million, 238.
Designed, built, and operated here in the United States, York is a modern defense prime. Space is no longer a distant, abstract domain. It is a contested environment. Becoming a public company rises the bar even higher, and we welcome that accountability.
We'll have more coverage of York's recent IPO later in today's show. And coming up, leaders from the 13th annual IPO Summit will ring the opening bell to kick off the final trading session of the week. Don't go anywhere. We'll be right back.
"16 years ago, an anonymous person released an idea onto the internet. No identity, no institution behind it, no marketing strategy. It was just a white paper and a challenge to everything we thought about money. What if money were open instead of closed? What if it belonged to everyone instead of being controlled by a few? Bitcoin survived every attempt to kill it because the idea itself was stronger than the forces that tried to stop it. And now, today, inside one of the most iconic institutions in the world of finance, we honor a creator who never asked for credit, never stood in front of cameras, and ultimately stepped away so that the idea could stand on its own. Satoshi Nakamoto.
Why are we here? Because Magnum Ice Cream Company is an ambitious company. We're all about growth. And for growth, you need people and you need to have belief that focus on only ice cream will propel this business. These folks here in the room wake up every morning thinking about ice cream, and they go to bed thinking about ice cream, and that's why it will be a successful company that delights the world with unbelievable products.
Welcome back to NYSE Live. In just a moment, leaders from the 13th annual IPO Summit will ring the opening bell. The theme of today's event, co-hosted by the Connor Group and the NYSE, is IPO Momentum, Navigating a Stronger Market. The program will feature insights from top IPO executives and advisors for companies exploring the 2026 and 2027 public markets. Last year's summit brought together more than 700 companies, including 139 unicorns, representing a combined value of $766 billion. Doing the honors of ringing the opening bell is Jim Neeson, Connor Group's managing partner and founding executive, and Jameis Winston of the New York Giants. Take a look. That is the Connor Group ringing the opening bell. You can also see Jameis Winston of the New York Giants. He was the 2013 Heisman Trophy winner as well, doing the honors there. We're going to be talking to Jameis in just a few minutes when I head down to the trading floor. But before we get to that, of course, we want to get a check of the market. This is the final trading day of the week. We mentioned that hot inflation data, and it's definitely weighing on markets in the first minute of trading here. Taking a look, the Dow off about 450 points to kick off this Friday, on track for a lower week. Joining me is Clayton Trick, head of portfolio management at Angel Oak Capital Advisors. Clayton, so good to see you again. Thanks so much for being here.
Yeah, thanks for having me again. Great to see you, Caroline.
So I know you take a more of a fixed income view, but I do want to get your take on the stock market here this morning. How would you describe the market environment right now? Not just the weakness that we're seeing today, but really the volatility and the rotation that we've been seeing so far in 2026.
Yeah, we, as you mentioned, we really specialize in fixed income and alternative investments, but we're obviously watching the equity market, especially the U.S. equity market. Expectations for this year, we heard a lot of comments from other strategists around potential turbulence. I don't think we have really had that much of an aggressive call, but we thought volatility would definitely pick up this year. You've seen so much PE expansion, especially in tech, and then we expected a more broadening out of the U.S. equity market, so a little bit more diversification going on. So we're not too surprised at the equity moves we've seen, particularly in February, and since February has been a choppy month, not surprised to see the last day of this month moving a little bit lower ahead of the open. So there's a lot of questions that are coming out, really around the technology side. And this morning we got PPI, which was a little hot, which is going to continue to keep that debate on Fed cuts alive and well as we head to a potential new chair in Q2.
Okay, yes, I want to dig into PPI and what it means for the Fed in just a second. But you mentioned the rotation that we've been seeing out of tech into other areas of the market, things like energy, materials, industrials, even consumer staples. What are we seeing in terms of that money going into bonds? And is now the right time for investors to be thinking about fixed income opportunities?
Yeah, absolutely. I mean, investors for a decade were really complaining that yields were so low. In 2022, we ripped the Band-Aid off, and yields have really been attractive across really all areas of U.S. fixed income, right? So treasuries at positive real rates, we're still there today. Agency mortgages, IG corporates, all areas have actually looked pretty attractive on an all-in yield basis. If you think over the last 40 years, U.S. fixed income relative to equities sticks out. So, while investors have different goals long-term on when they're looking to, invest and create wealth, fixed income, relative to equities has looked pretty attractive. So we've been saying investors should be a little more overweight bonds going into 2026. So we like U.S. fixed income right now. We're a little more selective going into this year than we were the last couple years because you've seen such a big rally in areas like U.S. credit on the corporate side, but you've seen more of a lag in the mortgage and asset-backed security side. So we've making some pretty strong rotations heading into this year to take advantage of that. But broadly speaking, U.S. fixed income looks really good, and investors looking for income should be more overweight fixed income than they usually are, given where equity valuations are today.
Okay, you mentioned being more selective. Dig in a little bit more about where those opportunities are, especially given the hotter than expected inflation data that we got this morning and what that could mean for the Fed in terms of potentially having to be on hold versus further cutting.
Yeah, so investors need to focus on kind of two main areas to take advantage, or kind of two main themes. One being protection of principal. And right now, the housing market we still think is in really good shape from a credit perspective. There are a lot of bonds within agency and non-agency mortgage-backed securities that should hold up really, really well in both an economy that reaccelerates here and also an economy that potentially could enter recession potentially next year. So we think mortgage-backed bonds should hold up over both scenarios. And so that's where that really sticks out. We're a little more cautious on the corporate credit side. You've seen a lot more volatility within private credit, especially a lot of the news that's come out even yesterday within MFS. So there's still a lot of concerns on the credit side, even if yields are quite attractive. We much prefer non-agency mortgages, especially bonds trading at a discount that were issued a couple of years ago. So those are extremely attractive, and we've been focusing more on that heading into this year.
All right, I'm getting the wrap signal, so you have to just give me a number here. How many rate cuts this year, if any?
We're thinking more like 3. It's gotten really quiet from a FOMC perspective, right? Seems like we're definitely heading into the Warsh expectations for the end of the second quarter, and so we think the market could be very surprised here and could get more of like 3 or more cuts really in the second half of this year as we get to a 2 handle on Fed funds. That's really good for the U.S. economy and really, really good for bonds, and investors are really not pricing that now.
All right, I have follow-ups, but we ran out of time, so you'll have to come back and tell me why 3. Clayton Trick, Head of Portfolio Management at Angel Oak Capital Advisors. Thanks so much.
Looking forward to it. Thank you.
In other news, Archaea Media Group, in collaboration with the NYSE, published the second edition of its Space and Defense Market Update, providing an overview of the key trends shaping the sector. Check it out.
All right, we are back with the second edition of the Space and Defense Market Update here from the New York Stock Exchange. I'm Mo Islam, CEO of Archaea Media. We're a news media brand that covers critical technologies and national security. I'm here with my co-host, Jack Kerr, who's our research director.
Good to be here, and just after New York City's first blizzard in 10 years.
Yes, we have our snow boots on, so hopefully we can keep the camera angles above the waist. Okay, so we have a lot to discuss. York's IPO, the general trend of capital rotating from software into hardware, Blue Origin's big month of announcements. But let's start with York. Since our last show, we have yet another space IPO. In this case, it's York. Went public at the end of January. Tell us a little bit about who York is and how did the IPO go?
Yeah, so York is a satellite manufacturer. The company raised $630 million here at the New York Stock Exchange. And they are a government contractor through and through. About 95% of their revenue comes from that government customer, which says a lot about where the industry is right now.
I think it speaks to a lot to sort of the narrative in public markets and how it's shifted. A couple years ago, it was all about commercial strategies and commercial revenue, and now the conversation is much more about durability and government dollars. So effectively like backlog, contract visibility, and whether you are showing up in the right kind of line items on the budget. And when you zoom out, it makes a ton of sense. The fiscal year 2026 NDAA was something like $900 billion, which is a record. So that's the backdrop that investors are underwriting against. So it's a market where the defense exposure isn't really like, it's not a side benefit to the story anymore. Like it's become the story.
Yeah, and historically there's been a stigma around this defense exposure, and partly that's due to some of these aerospace and defense primes that have generated a lot of revenue, but have had a little bit of trouble converting that into a substantial profit. So that's a lot of the arguments for these space tech and defense tech companies, is that they can come in and introduce new and advanced manufacturing practices and operate a lot more efficiently, and in turn can generate more meaningful profit. So you look at York, for example, we're just talking about York. If they can come in and they can execute at a higher operating margin, they just need to carve off a slice of that government revenue, and they can generate pretty meaningful profits.
Exactly, and you're actually starting to see a lot of that logic apply to private markets. Deal activity this year has started with like a huge bank.
Yeah. I mean, the SpaceX XAI merger is the big one. SpaceX being an AI company is kind of wild after 20 years of them being around, but it really solidifies SpaceX's bet on moving compute and moving data centers into space. So we have that merger. There's a number of other deals in space that have come out in the last couple months. We have Cesium Astro raised $470 million for its satellite communications tech. Stoke, which is developing fully reusable rockets similar to Starship, raised a $300 million extension round. Commercial space station builder Axiom also raised $350 million. And just the other day, Alaria raised $100 million at a $1.3 billion valuation to further roll out its communications technology.
Right, and you're also seeing notable raises on the defense side, and just to name a few that I think are more notable, like Skyrise, the flight automation startup, raised $300 million. Novion Magnetics, which is a rare earth magnet maker, raised $215 million. And then across the pond in Europe, Harmattan AI raised $200 million, so autonomy startup. So the large critical industry funding rounds have really picked up, effectively like right where we left off last year.
And we were discussing this a couple weeks ago, but there are a number of macro tailwinds that are supporting these industries. But this year in particular, there's the big one is the AI-induced
investor pivot or rotation out of software and into hardware as investors kind of try to find where the moats are. We saw already this year software ETFs are down 25%. Enterprise software stocks in particular have been hit harder, down 30+%. And for decades it was these asset-light, high-margin software businesses that were considered world-class. They had these incredibly high switching costs, and you can generate a lot of recurring revenue because of it. So now investors are questioning those switching costs and those moats. So as a result, they're looking at hardware. And hardware is seen as this place to be insulated. When you're building in the physical world, it's a lot more harder. It's not just a software program. You can be insulated from AI.
Yeah, that's exactly right. I mean, for years, no one wanted to touch hardware. And it's too capital intensive, like low margin, and just in general, just like very difficult to execute. And when you look at like manufacturing, like certification, supply chain, flight heritage, all of those things are actually like deep moats that are not easy for AI to erase, like at least anytime soon. So investors, I think, are asking a very different question now, which is, it's less about like, is it asset light, and more about, is the company solving a strategic bottleneck? And in the case of space and defense, there are a lot of those bottlenecks are pretty obvious. You have like launch, power, comms, autonomy, materials, production capacity. And if you can actually own and control one of those layers, you're effectively infrastructure.
Yeah, and you're also building, or you get to invest in a frontier. I mean, we don't know how fast space will be built out, but I can say for sure it is going to be big. And so we were talking about the moats, this kind of defensible moats that hardware, and particularly space hardware, can have. But you're also, an investor can invest in a growing ecosystem that you can kind of create this foundational player, or invest in this foundational player that can be around for decades.
Yeah, well, speaking of that, let's talk about Blue Origin. So Blue is starting to look less like a single product company and more like an integrated infrastructure player.
Yeah, and Blue Origin was founded 2 decades ago, and they've, no offense to any Blue Origin employees, but it seems like they've been in hibernation for those 2 decades. And then all of a sudden last year, things flipped. In November, they landed their New Glenn booster for the first time, which was a big milestone. They then, like a couple weeks later, announced they're building a larger variant of New Glenn that'll be 4 times the size, 4 times the capacity as Falcon 9. And then just in the last 30 to 45 days, they had a blitz of announcements. There was the next New Glenn launch, which should be happening in the next couple of days, will be powered by the previously flown booster. They're posting jobs about working on a reusable second stage, which is a big deal. They paused their suborbital New Shepard rocket to go all in on the moon. They're working on a smaller lunar lander variant to beat SpaceX to the moon as well. And I know this is a long-winded list, but really the big one here is Blue Origin announced its TerraWave satellite communications constellation, which will give them the vertical integration where they can sell through. They have New Glenn as the rocket and the infrastructure, and then they can sell through on the application layer. And this is something that we saw SpaceX do a phenomenal job at with Falcon 9 and selling through Starlink.
I'm just so honored and so grateful to you, Lynn, for welcoming us to announce our Time Person of the Year, the architects of AI. I want to take a moment to welcome Chris Lehane. You have been an incredible driving force, making AI accessible to everyone, and we are so glad that you are here with us today. We are focusing on the leaders and the people and the humans that are imagining and building this future that we will all be living in.
We had somebody ask us recently, why are you going out at this time of the year? The reason we're doing this is for our people. It's not about us. Our motivation for doing this transaction is to make this a better place for the next generation. We have a stewardship responsibility to our people to give them a professional and a financial opportunity that's better than what we have. And what I am very proud of is the team that we have here. This is a true partnership in every sense of the word.
Welcome back to NYSE Live. Earlier this hour, leaders and speakers from today's IPO summit rang the opening bell. That includes Jameis Winston, New York Giants quarterback and 2013 Heisman Trophy winner. He's here with me now. Jameis, congratulations on being on the podium today, and I understand that was a dream of yours that came true to ring the opening bell.
Absolutely. What I set my attention to, I attracted, and I'm so happy and grateful to be here at such an amazing establishment and to feel the energy and to be able to be a part of ringing the bell was just such an amazing feeling.
And you're going to be speaking at the IPO summit a bit later today, speaking to investors and founders, entrepreneurs. Tell us, what's the message that you're going to be bringing from the field to the boardroom?
Well, I believe being an executive, opening up a business has a lot of parallels to being an athlete, being in terms of the discipline, the persistence, the mentality that is required for success. So obviously I'll start with gratitude, and I'm very grateful to be here, and I'm also grateful to just speak life into all these individuals about what's to come for their business.
I've heard that you have your sights set on launching a business or IPO of your own. Tell us about what we can expect with that.
Well, one thing that I attract is great vibrational frequency. So with my concept, I will be educating, impacting, immersing myself with whoever I'm with, and I will be integrating great people to help me align to what I would love. So with that simple thing being said, I will be ringing the bell, and I will be back here to do that.
All right, you heard it here first. Obviously, being an NFL quarterback, you've been through the highs and lows. Any pro tips that you swear by that can really, kind of translate to the business community? Yeah, well,
when it comes to dealing with adversity, I typically turn to my faith. And one of my favorite Bible verses, my family Bible verses, I can do anything, I can do all things through Christ who strengthens me. But before that, Paul who's in jail, he's talking about being content with abundance and being content with nothing. So contentment doesn't necessarily mean satisfaction. So I understand the importance of being content in every situation, but I continue to endure and continue to fight for what I would love.
All right, so speaking of helping out, you're giving your advice to business leaders, but I understand you also helped kind of mentor Jackson Dart in his first season. Any fun stories there to tell us about?
Well, I just know he is such an amazing human being, and his energy was so infectious. It really reminded me of myself when I first joined this league. But the impact and the expectation for a young quarterback coming into this league and how he just embraced that and went out there with joy and competed his tail off was just exciting for me to watch. And I just think that energy that he reflected, I was able to embrace that and pass it back to him. So I look forward to growing with him and watching him become a superstar in the NFL.
All right, I'll get the real fun stories off camera here. But I understand you're also very involved in the Dream Forever Foundation, yes. So we want to hear about that. Tell us more about what you're doing there.
Yes, our mission is to, typically, is to align the dream of young boys and girls to what they would love. We are in a business of qualifying them because their dream is already there. We just want to be able to provide access and resources to them for them to be able to attract those things. So we like technology space. I believe technology is the most important thing in the world right now. So we want to provide them with all the technology, all the training and AI prompting, all the tools that is required for success they already have, but we have certain partnerships and brands that can help them kind of fast track that to success.
All right, and finally, we only have about 30 seconds left. What can we expect next season from you on the Giants?
Well, you can expect the New York Football Giants to be a tough, competitive team with a will to win, and we will be winning a lot of football games. And it starts with that, because that will to win and that desire for success is already in our hearts. Now we got to be able to provide that vibrational frequency to this great city, to New Jersey, and all over the world.
Yeah. Don't forget New Jersey, too. Jameis, thank you so much. Congratulations. Great to talk to you.
I will never forget New Jersey, but thank you. Caroline.
I thought you were going to sing Sweet Caroline. All right, coming up, the EB Research Partnership is on a mission to eliminate rare diseases. Find out how the organization is working toward that goal next.
I know 100 years isn't much in the New York Stock Exchange laurels, but we're very proud. First U.S. airline to reach 100. The resilience and the determination to move forward despite all odds is something that I think we're all proud of. We've had a great opportunity to celebrate this year. The power of obsessing on our customers is what makes Delta really great. And my superpower, I'd like to think, is obsessing on them, on these people, so that they can go do the job. And it's not just me, it's our leadership team in terms of making it happen.
It's a bit of a pinch me moment. I mean, everyone's here. Here we just rung the New York Stock Exchange bell. In a lot of ways, it's a dream come true. When you walk around the NYSE floor, it's just emblematic of the American dream. Look, if I can do it, others can do it too. So believe in yourself, work hard, be the best you can be every day, and it compounds.
A plan to go and change the way people fly, it is the next step. When we look back at what we promised to go do and then we go do it, it'll be the foundation of our business that builds us to the next step. And it's because of the people here and what you all did, which was enabling greatness.
Welcome back to NYSE Live. The EB Research Partnership says that it's on a mission to eliminate EB and other rare diseases. NYSE content creator Ashley Mastronardi sat down with EB Research Partnership CEO Michael Hund, as well as 12-year-old Thomas DePalma, who's living with EB. EB is often nicknamed the butterfly disease. Take a listen as to why that is.
EB, those that live with EB are called butterfly children because their skin is often as fragile as a butterfly wings. So EB impacts about 500,000 people in the world, and it's very difficult. You know, those that battle EB can have hours of bandage changes. They can see more than 30 different healthcare providers just for their treatment and care. But the good news, the optimistic news, and maybe one of the few positive things about EB as a rare disease is that it's caused often by one gene mutation. So that gives us hope and that gives us optimism. And our mission is, quite simply put, to accelerate treatments and ultimately find a cure for all those living with EB.
And Thomas, you're living with EB, but before we get into that, can you tell us a little bit about yourself? Who are you? What are your hobbies? I understand that you're in the 7th grade, you're 12 years old. Tell me what your life is like.
So I like playing sports like basketball and baseball, but it's like, it impacts me sometimes, but like other times I just feel like a normal kid, like just hanging out with friends and just like going to school and all that normal stuff. But yeah, it's like only difficult sometimes. But.
Okay, and what are some of the challenges? And then also, has it enriched your life in any way? Has it made you more resilient? How has it impacted your life?
It's impacted me in like 2 ways, like good and bad, because I've definitely grown stronger because of it. I've been more resilient to pain, but it's also like slowed me down sometimes, like having to skip games or practices just because I have to listen to my body sometimes. But overall, it's like making me stronger as a person. So.
When you say you listen to your body, what is that like? Is it?
So, it's like whenever I feel like something's just not right, like maybe I feel some pain somewhere, I have to like not risk it and just like take a break, because I know like if I don't, like something really bad might happen.
All right. And Michael, can you explain what venture philanthropy is and how the EB Research Partnership is using that model to help eradicate EB?
Yeah, absolutely, Ashley. I mean, first of all, just to acknowledge something that Thomas said, resiliency and strength. And when our mission started, it was a group of families that wanted to save their children's life. We were co-founded along with Jill and Eddie Vedder of the band Pearl Jam, and that resiliency is a big part of what we do, is learning from people like Thomas of what that strength and that courage is and that bravery is. And for us, that meant, not approaching curing a disease like everybody else on the planet had done it. That meant a new approach, a new model, an innovative approach. So, it's very fitting that we're here at the New York Stock Exchange, because many of the companies that grace this stage and ring that bell,
they've done something different. They've done something innovative. And, we're big believers in that as a charity, 501c3 is a tax status. That's not a business model. So we believe that we ought to run our nonprofit and our mission in the same way that the companies that grace the New York Stock Exchange is. And what that means to us is taking really good business models and applying them to curing a disease. So that means building innovative technology platforms that leverage machine learning and AI. That means incentivizing collaboration. How can we get universities and academics and companies and patients and families to work together? And then really at the middle of that, and a pillar of what we do is venture philanthropy, which means a lot of medical research organizations write checks and they hope for the best. We're impatient on behalf of patients. So we believe there's a better model. So, when we started, there was really not a lot of research. There was 2 clinical trials. 10 short years later, we've gone from 2 clinical trials to 50 clinical trials, half of which we've directly funded. We've raised $80 million. We've funded 200 projects in 20 different countries. And every single investment that we make, in essence, is a venture capital investment. So we build equity upside. So if those projects are commercialized, the economics come back to the foundation to fund more research until we cure the disease.
Be sure to catch the rest of Ashley's interview with Michael Hurd and Thomas DePalma on the NYSE app. Before we go, let's take one last look at the markets. That hot PPI data not doing any favors to stocks right now because we're seeing red across the board. Right now, the Dow is down almost 800 points, about 780 points right now. That's about 1.6%. The S&P 500 off less than that, only about 0.9%, looking on the bright side there. The Russell, the worst performer right now, off more than 2%. We still have, 6 hours left in the trading day, so anything can happen. But right now, stocks decidedly lower, looking like it's going to be a lower week as well. That'll do it for today's coverage on NYSE Live. I'm Caroline Woods. Have a great weekend, everyone.
Welcome to the public market.
The New York Stock Exchange is a cathedral of the capital markets. So there are a few places more fitting to consider the future of American financial system than this one.
So thrilled for this next chapter to begin today with all of you in this historic building.
The day we went public, it was the most bizarre day of my life. He said, yesterday, Shake Shack was the most beloved hamburger company in the entire country. Today, it's going to be the most reviled stock. He said, you guys are never going to grow into your $46 valuation. How many Shacks did we have 10 years ago? 31 Shacks. And did I not just hear Rob say that we're going to have 1,500 Shacks? So yes, we grew into that $46. It's all because of you guys. I'm so proud of you, every one of you. You work so hard to make so many people happy, and you make your communities better. What more could you ask for?